It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi Ho, it's the governor of the great state of Texas, Mr. Michael Becker. Michael, how are you?
Paul, back from my summer vacations and 105 back in Texas. So kind of landed about a week ago and almost got back on the plane and went back to the cooler weather. So it's just definitely hot here in Texas.
Certainly very hot in Texas. Now, unfortunately, I don't know if the real estate market is that hot, but it's certainly the temperature of the air is certainly pretty damn hot here in Texas. Don't forget, coming up October 4th and 5th, the Old Capital Conference, talking about hot. We want you to come. That's where all the people that want to buy real estate, the people that own real estate, whether you're a general partner or a limited partner, whether you are a broker, whether you are a banker, you want to come to the Old Capital Conference on October 4th and 5th in Dallas, Texas. This is our one-year event. There's usually 500, 600, 700 people that show up for that. Just a great place to network. And then you get to meet folks like Michael Becker. So, Michael, what's your 2 cents on the Old Capital Conference?
Yeah, no, it's always a good event every year. We get to kind of mix and mingle with people that are out there actually doing deals in the business. So, it's not only, a lot of principals and kind of sponsors and limited partners, but you have a bunch of the brokers out there actually doing deals and kind of everyone in between on your vendor team. So if you guys are active, specifically with the Texas bend in your investment criteria, there'll be a lot of brokers there that are out there actually selling deals. So if you ever want to meet any of these guys, good chance there'll be someone from the team that you want to meet at the conference. So that would be a good use of a couple $100 and an airplane ticket to come into Texas and go to the event.
That's right. How do you increase your net worth is with increasing your network. So being part of the Old Capital Conference is certainly a big step forward. And again, go to oldcapitalconference.com, oldcapitalconference.com, RSVP for that event. And we will see you October 4th and 5th in Dallas, Texas. Certainly look forward to saying hello to you. I know Michael Becker will be there too. So make sure you buy him a beer, so to speak. Michael, is there any way we can break open the SPI playbook and just see a little bit about what you're thinking, what's going on in your life? You guys are you're looking at a transaction right now. And so I'm going to kind of piggyback off of that and just kind of figure out a little bit about how you get a deal these days. How do you get it financed? Talk a little bit about just an opportunity that you guys have coming up, because again, this is for accredited investors, but I just want to kind of have in the moment of what you guys are thinking about buying properties today in July, August in 2023. Let's kind of hear a little bit of your playbook. Tell us a little bit about this transaction, how you guys got it.
Yeah, we'll go take a quick little step back. I mean, we've been real busy and a lot of, end of 21, all of 22, and first quarter of 23, we sold 10, 11 of our properties and refinanced a whole bunch of them too. So we've been real busy kind of getting the house in order. And then last year, I think we only bought a couple 3 deals in 2022. So we were like a 3-to-1 net seller. And we're kind of getting sick of selling stuff. And I think it's kind of time to start buying, to be honest with you, Paul. I mean, and what we focus on and what we're currently focusing on is kind of more your better quality assets. So kind of your A to A minus, typically suburban product is kind of what we look for. And we're in Dallas, Austin, San Antonio, and right now kind of more focused on Austin and Dallas and than San Antonio, just kind of where we are. And even more specifically, even Austin, I think where there's some opportunity in Austin where it's been a real difficult market the last handful of years. We hadn't bought that many assets in the market because it was just really hard because everything's getting bid up. And now there's a little bit more opportunity. So that's kind of what we've been focused on from like a bigger picture, Paul. And we're starting to see, some of the transactions come out, and there's several institutional sellers, one of which we're buying this asset from, probably seen in the headlines, not naming names, that had, some redemption issues in their funds where they have more requests for money than they have availability of capital. So it's kind of forcing their hand to sell in an inopportune time. and they're looking to generate some liquidity so they could stay on top of their redemptions. And we took advantage of one of those opportunities a few months back, and we're back at another one from the same seller. So this particular deal, what we like about it is, we're I think just kind of as a market, we're getting pretty bullish on the Class A and A minus, and I still think there's more room to come downward on price, the workforce housing, but we're seeing, in this case, I would argue probably 25% off the peak price. The peak price was, kind of Q1 of 2022. This is probably 25%, give or take, off that peak price. And that's a pretty big discount to, a bunch of comps that traded. And then this is also a pretty good discount to current replacement costs. You haven't seen current replacement costs come in dramatically yet. So we're still, a pretty decent discount to current replacement costs. So historically speaking, this seems like a pretty good entry point if you can find something with those two characteristics. So that's kind of the setup of the deal, Paul.
Tell me a little bit about how you guys found the deal. Did you guys go through a broker? Was this thing mass marketed? Were you guys won this deal by paying the highest price? Just give me just a little bit of background. Again, we're opening up Michael Becker's playbook so you can understand. And I want to just point out that Michael didn't start off in this space just going out and doing Class A properties. He started off like you. If you're just getting the multifamily, he was an investor, and then he bought some Class C properties, and he, over a period of 10 years, he worked himself up to buying higher quality assets. So again, did you pay top dollar for this one, Michael?
Yeah, so the two main ways getting deals are marketed or off market, and depending on the time and the situation, some are better, some are worse. So this particular deal was a marketed deal. It was fully marketed. We went through the bidding process, and we were actually not the high bidder. There was two groups above us, and the first group, this was actually a 2-property portfolio, and another large institution was going to buy both assets. And we were only interested in the smaller of the two, which is the one we ultimately got. And then that group was awarded the deal and backed out for they had some liquidity issues internally, and they ultimately didn't go forward. The second place group that was above us, their profile wasn't nearly as strong in the marketplace as our profile. So the seller and the broker, this was our 7th deal with this broker and our 5th deal with the seller. They pivoted and specifically targeted us and try to get us to come up on price. We basically held the line that we were just gonna kind of hold our pricing line, and ultimately they needed the liquidity and they decided to just go with us. So we were not the high bidder, but it was our track record successfully closing 4 prior deals with the seller specifically that got us this transaction. So that was kind of the story of this deal. And sometimes off-market deals are better, Paul, and sometimes market deals are better. It just kind of depends on the situation. But that's really what happened here.
And again, you've done a lot of business with this broker, so you're a proven commodity for one. So that's why they were able to vet you guys out. And the seller, you'd done a lot of business with the seller, and then they got able to vet you out. That helped you, that you didn't have to start from square one when you guys were kind of negotiating the contract. That you already seen the contract 4 times prior to this, and the 5th time is that you already knew what the hot buttons were, and so that's probably saved you a little bit in legal cost, I would imagine.
Yeah, and time. That's a big point for the sellers. The seller specifically is we already had a contract that's beaten into shape a few times, so that was a big selling point. This is, if anyone's heard us talk on this podcast over the last many years, we always say it's a completely unfair business, and this is a good example of that, being on the right side of the unfairness here. So that was really kind of the setup of the deal, and that's kind of what you're seeing in the marketplace. Certain sellers are chasing price and rolling the dice on unproven groups without hard money, and maybe they go through, maybe they don't. And then other groups are valuing certainty of execution, kind of depending on their situation. That was the case of this guy, the seller in this group. And then, what we liked about it, like I said, was like I think somewhere around 60, 70 a door below sales comps from 12 months ago for inferior product. And I think this deal would have probably traded almost 80,000 a door higher if it was actually for sale on the marketplace, say Q1 of 2022. So this is a hell of a discount to actual trades that happened in the marketplace. And again, I think it's 30,000 or so below kind of current replacement cost per door. So these are just some good metrics that we're tracking. And by that, I mean, we're basically at positive leverage, which our cap rate is basically where our debt rate is, assuming we haven't locked our rate yet, but assuming we lock our rate where it would be today, I mean, we're basically right at neutral to positive leverage, which going in, which hasn't been a thing in Austin in many years. So we feel pretty good about that. And then, our year one cap rate is definitely positive leverage by a margin. So we're actually able to produce a little bit of yield, and the returns are a little bit better than what we have shown on, last 2 years worth of deals, really. So we're starting to see some, market correction, and it's really kind of bleed through into the return. So it's getting us to be kind of bullish in general and here specifically.
Talk about the advantages that you have, whether it's you or somebody else, when you compete in a same market. So what I've seen a lot of people that are brand new into the multifamily business, that they chase, whether it's cap rates or they chase areas that people have had success in the past, but they'll do a deal in Dallas, and then the next deal they'll do is in Jacksonville, Florida. Next deal they'll do is in North Carolina. Next deal they'll do is in Utah. Next deal and I just keep going on for all these different places. Now, you guys have not been skipping around the country. You guys kind of concentrate in one area. And what are the advantages for, say, somebody that's new that doesn't really understand? You shouldn't be trying to make those arguments that you don't have to go all over the country. What are the advantages of staying in one area like you guys?
Yeah, like we just talked about, right? We have a reputation, a brand within the markets that we participate in. And you mentioned we started in Dallas-Fort Worth, and it was, 6 years, I think, before we went to Austin, and then a couple of years there before we went down the 35 to San Antonio, which from an investment sales standpoint, they function kind of as one market, because the same brokers cover both Austin and San Antonio. So we're in effect, we're really probably in two markets from that aspect of it. And we just focus on it. And we're a bigger market. So we have a lot of velocity of deals and a lot of opportunity to pay attention to. And a group of our size, that works well. So but to your point, I think if you bounce from, this market to that market, especially if some of them are smaller and tertiary, it's really hard to manage this stuff, one. And then two, is one of the best things you get when you buy a deal is a bunch of goodwill within the marketplace with the investment sales community, and everyone knows that you can successfully buy a deal. So why give up that goodwill? I'm always looking to monetize that goodwill over and over again, and be a repeat buyer with the broker or a repeat buyer with some of these sellers. And that's really something that we value. And I think is maybe undervalued when you take kind of the scattershot approach on doing a little bit of business in a whole lot of markets.
But let's talk a little bit about the practical sense, because you have one management company that manages your assets in and around that area that you're already familiar with. Some of the people that, the regional managers, that oversee your properties. Talk a little bit about the bench strength that you pick up by concentrating in one area versus, scattershot across all these different markets. So again, it's always been my theory that you should find one or two areas and go deep with the relationship in those areas, whether it's the brokers or the plumbers or the electricians or the roofers. Try to build all that credibility within these groups. So when you do have something that needs to be done, that they already know who you are, and you're not going through your Rolodex trying to figure out that who should be the best person for this. You already know that about what's going on. Talk a little bit about the practical sense, Mike.
Yeah, this makes everything easier. I mean, you kind of understand what to expect. It makes the sizing a deal and specifically that much easier when you know what your operating costs are on a bunch of similar assets that are, located nearby. So I don't need to reinvent the wheel and see the taxes calculated differently in this market, or what should insurance costs be, or this or that. Those are things you got to verify. But as you kind of trying to skim through, 100 deals to find the one that might work, Paul, having that kind of tribal knowledge or historical knowledge of what things, cost and et cetera, or who to call to find out about this thing or that thing, really makes the process of kind of sifting through all those deals go that much quicker. So that's really one of the biggest things. And then, when you own a bunch of assets that are close proximity, you should be able to get some operational efficiency as well, and maybe pool some labor in particular, or maybe some of your landscaping costs can come in or trash costs come in by having assets that are nearby each other and kind of rolling up your vendors. You maybe keep it a little bit better pricing as well.
Yeah, definitely get a competitive advantage out there where, again, economies of scale, when you start to own concentration in some of these areas, that you really can start to save costs, and that makes your operating expenses a lot lower. Maybe not 100% lower, but maybe 12% lower. In this game, that's a lot of savings that you can incur. Mike, I know we're not using this as a tool, but people want to get more information. I mean, I'm talking about accredited investors with you. What's the best way for them to get in contact with you? Then I have a follow-up question, which was really my Ask Mike Monday question. So what's the best way for them to get in contact with you?
Yeah, people want to find out about this deal or just learn more about what we do. The best way is our website, which is www.spiadvisor.com. It's SPI, like SPIadvisor.com. There's a new investor form you kind of click on, fill that out, and send you information about this deal. If whether you're interested in investing today or just learning a little bit more, this would be a good kind of snapshot on how we analyze and put together a package of this deal. So encourage you to take a look at it, and if you happen to have some investment dollars, that would certainly be something to think worthy of consideration. We're sticking in 7 figures of our own cash into this deal as well, Paul. So we're going to have material skin in the game, and I feel like it's a pretty good moment in time in general. And hopefully we're going to go on a little run, and we're done selling and we're ready to buy. Because I think in 2025, 2026, I think are going to be 2 years that are going to be hell of a good rent growth years, and we're trying to do our best to get positioned ahead of those 2 years as kind of the macro supply pipeline is being delivered. And the last 6 months, since we've had a little bit of turmoil in the major turmoil in the banking industry, there's not much construction lending going on, so there's going to be a hole in multifamily supply in 25 and 26. And those of us that own high quality assets that are well located, I think are going to be paid off in spades. And we're trying to exude and live the famous Warren Buffett quote of being greedy when others are fearful. Right now there's a lot of fear and uncertainty out in the marketplace, and we are trying to do our best to act with some conviction and go out and take advantage of this discounted pricing and the better located, nicer kind of Class A product space. And I think we'll pivot ultimately to the back to the workforce housing, maybe later this year or into 2024 when some of that stuff starts shaking loose a little bit more. So that's what my crystal ball. And, we are convicted that this is a hell of a good time to start buying some of this stuff.
Yeah. Again, only for accredited investors. Talk with Mike and his crew over at SPI, Strategic Property Investments. Talk with him and his group and see if this is something that would make sense for only if you are an accredited investor. I can't say that enough. All right, Michael, you are a former banker. I mean, almost like a Marine. You're always a former Marine. I want to talk a little bit more about underwriting. Back in the day or so, when you would look at some of these transactions, I mean, you worked for one of the largest banks in the United States. You led the division for that bank. You did more business than pretty much everybody else in the Southwest. And so you were very successful at that. Give folks that maybe are not so familiar with bank lending from yesteryear, and then I could talk a little bit about bank lending today. Talk a little bit about general guidelines as a former banker when you would maybe look at apartment transactions or warehouses or anything that had to do with the commercial piece to the deal. Again, not single family, not short-term rentals, but just talk about general guidelines of being a banker and what are some of the things that people who've never probably have done a commercial loan, what they should be thinking of.
Back when I was a banker, we were basically, I was always on the balance sheet side, and we typically
what does that
always
mean? What's the balance sheet?
we lent our own money out from the bank. We weren't a correspondent lender or an agency lender where we would go securitize a loan. The money we lent out was held on the balance sheet of the bank, and then we had to service it and go collect that money one day, right, Paul? So everything we did generally speaking, had recourse to it. So you had to sign a personal guarantee. And back 15 plus years ago when I was doing this stuff kind of predominantly for starting out. And then I left 10 or so years ago. Kind of there's two parts of my career, pre-Great Recession and post-Great Recession. Those are very, very different lending environments. But back in the bad old days before, 2005 to 2007, we're making a bunch of these loans. There was very loose liberal lending standards, which are very well documented. And then kind of coming out of the Great Recession, when I did the predominant amount of business, especially the multifamily, we had a bridge program, and you and I together did a whole bunch of loans and kind of, as you would call it, put Humpty Dumpty back together. So we would take these broken properties from 08, 09 and put a bridge loan to, spend some money, improve the physical condition of the asset, improve, the management, and increase the value. So it was kind of the beginning of the big value add craze that went on for, 10, 12 years. And we made a lot of those loans, and we would require, typically, somewhere around 30% down. So it'd be like a 70-30 loan. We require full recourse. And we'd want the people that have signing the mortgage, they would have to have a significant amount of money into the deal. And they would have to have, net worth of kind of equal to or greater than the loan amount. And then you'd want to have them have some substantial post-closing liquidity. Kind of the minimum I would say would be about 10%. But, if they had a bunch of other contingent liabilities or other loans they guaranteed, we probably require that to be even a little bit higher. And, it's a completely different world than what kind of the last 10 years really, or the last 7 or 8 years of the last 10 years really where there's some debt fund money and a lot of agency execution. So it was completely different than what the last few years are. And we're kind of going back to that a little bit, but the banks are right now, and you correct me if I'm wrong, but largely speaking, a lot of the balance sheet lenders are, the faucet's off. There's not a lot of money flowing. So that's not a ton of the transactions aren't really going that direction at the present time.
Let's talk a little bit more about that. Just one or two more parts. The one part that you had mentioned is, let's talk a little bit about structure. Structure is how much of your own money was going to go into these deals. And so a lot of these deals were done with, say, this is 10 or 15 years ago, 3 rich guys or 3 rich gals, an operator, his brother-in-law, and some rich guy, so to speak. So 3 people, and there really wasn't a lot of the syndication model. So 10% was syndication, 90% was the 3 rich guys and gals scenario. And it was really there was not a non-recourse piece of the deal. It was full 100% recourse. So they wanted to make sure that if you were to ever default, that they could cure the problem. There was a deficiency balance because they had to make sure that grandma or grandpa or Aunt Judy, who had the money in the bank through the FDIC would want to make sure that there was a tag back to you so you could cure the problem by paying the money that the bank was out of pocket, an expense to do it. But Mike, going back to the good old days or so with the bank lending, how much you guys really didn't like the syndication model, for one, and then 2, how much money were you requiring for some of these people to put into the deal? Because what they didn't want to see happen is the person that was on the hook for the loan get thrown out if there was something that went down. So that,
we like I said, we would typically require.
They didn't want the crew to change out the captain.
25 to 35% down was your typical down payment, and then of the equity. Back when I worked at Wells Fargo, they had a policy that 51% of the ownership of the deal had to guarantee the mortgage. So we couldn't like nowadays where you have maybe the sponsor puts in 10% of the money and raises 90% syndication, which 10% of the money is still quite a bit of amount of money, especially when the deals have gotten so large. Of these deals were much smaller back in the day. We're making $3-5 million loans. I mean, we're not making not doing 50, 60, $70 million deals. So these were a much different animal at that moment in time. But if you had $1 million in equity, they wanted the people that put in $500,000 to sign the full recourse joint and several. And then they would do, sometimes it would be, kind of maybe pro rata or, something like that. But that was, real. And then I'm sure that's shocking if anyone's gotten the business the last handful of years. That really hasn't been something that's been in place. And maybe that's where we're going. I don't know if that's what you're getting at, Paul, but that might be where we're going.
That's where we're going. Yeah. So talk a little bit about joint and several, what that heck because a lot of people are not familiar with that term. But if you sign a recourse piece, what does joint and several mean, Michael?
Yeah. So if Paul and I both sign recourse on the loan as joint and several, meaning if we default, they can sue me for 100% of the deficiency, or they can sue Paul for 100%, or they can sue us collectively. So usually in those deals, they start with the richest guy and work their way down. So depending on who's richer between Paul and I, it's probably they got to go knock on someone's door first. They start with the richer of the two, and generally how that works.
Yeah, so that's something to always consider. So if you put in X amount of dollars into this deal and you think the only thing you have at risk is just that X amount of dollars, if that goes, that's not the case. Joint and several really means if they're going to collect, they can collect the full amount either from you or my partner, Michael Becker. So just sometimes to make sure you talk with your attorney and figure out exactly what that means. Are there different ways some banks can maybe drop that contingent liability or that piece against you, Michael?
If you have more equity down, you can get some lenders that'll do non-recourse. And when the world kind of opens back up again, and listen, this is a moment in time, right? I mean, we're not here forever. I mean, my experience is, this it always feels the good times, it always feels like it can go up forever, and the bad times it feels like it's never going to turn around. But it's a cyclical business, and we just have been in a period of time there really wasn't a down cycle. I thought COVID was going to be that thing, and it probably would have been in 2019 and going in 2020, but all the stimulus money is response to COVID probably kicked the can a couple of years, and now here we are. And you just got to kind of put your head down, and as I think James Ing was coined, survive till 2025, and get your house in order. Hopefully the last year, 15 months, get your house in order, and we'll get on the backside of this. And in the meantime, there's some opportunity right now for those that have the courage to take advantage of it. I think there's some opportunity, but to answer your question, Paul, I think you just put more equity you have in the deal, you'll do it. Then when these lenders kind of work through all the current problems and realize they need to start loaning money to make profit, there'll be some more competition, and then competition gets the structure to be looser, and then looser structure to make higher prices, and higher prices get more people throwing money at it, and then ultimately it'll go too far and you start back over again. That's what the cycle is.
Yes, indeed, it does. All right. We're going to finish off here. Michael, again, high level about that opportunity down in the Austin area. Just again, give me 2 or 3 bullet points that, again, the reason why your crew likes that again for accredited investors only.
Yeah, no, if anyone's interested, again, our best way to find out information is our website, which is spiadvisor.com, and there's an investor forum to fill out, get our database. But what we like about it, Paul, and what's getting us to put in 7 figures of our own cash into this deal and take advantage of some fear in the marketplace is we feel very, very confident that this is there's several, dozens and dozens of comps that at the peak of 12 plus months ago that were materially higher in sales price. So, we're talking 60, 70 a door for an inferior product that traded higher than what we have. We like that too. This is below current replacement cost. So we think that's a very good entry point when you can get below current replacement costs on high quality real estate like this. And then, we're going to be relatively conservative with the debt structure here. It's Fannie Mae full term IO, and we should be in the very low 5s when we fix our rate here. And so that's great. We got this thing slipped in before when Fannie Mae was giving 35-year amortization waivers. We, for sizing purposes, we got one of the last ones before that shut down. So we're grandfathered in with that, which is great. And we use our, long successful track record of repaying Fannie Mae to get better spreads and pricing. And that's kind of what is a benefit and part of the unfair business. So, and then we think that, we get into this deal at this attractive basis with those kind of things I just mentioned. And, we have some runway upside right now. And then I think when all the builders stop building, which all the projects going are going, and then the ones that are should be started right now are not getting started, there's going to be a rager of rent growth coming in 2025 and 2026. I'm convinced of that. And we're doing our best right now with this deal and hopefully several more to come behind it to position ourselves ahead of these rent growths. And I think that'll be some serious cap rate compression at whenever that moment in time comes. And the lending market opens up again, because they can't not loan money forever. So we'll start loaning money, and it's not just the agencies. There'll be some other lenders out there. I think that when that comes back, those of us that had the conviction and courage to buy today will be handsomely rewarded in the not too distant future.
Fantastic. I asked for 2. I got 7. So that must be you must be have some passion with it. So again, thanks for the information, Michael. We certainly do appreciate it. Again, Michael Becker with SPI. Certainly do appreciate it. Again, I'm Paul Peebles. Have a good day.